I am Carl York with the Kansas Department of Revenue. Just need to let you know by showing up here will not flag you for an audit, so don't worry about that. This is sort of like Vegas. What it said here stays here. With that said, I'm not sure if anybody's in an audit right now. If so, well, I'm sorry about that. The more people that are in an audit, that sort of determines the mood of the class. So hopefully everybody can hear me. If you see my mouth moving and you don't hear me or something, let me know. I see somebody said there is no audio. Hopefully you can hear me now. I'm not sure, but oh, it's working. All right. My wife would really love to have one of those mute buttons, I think, and she would use it all the time. This class is for construction contractors, so it's a little different than the class we had this morning. We had a retail sales tax class this morning. So real quick, what's the definition of a contractor? For sales tax purposes, it's somebody who installs or applies tangible personal property into real property. So fancy words for someone who installs a physical item like a 2x4, concrete, rock, wire, plumbing, into real property. Real property is real estate. That's permanently affixed buildings and land. So if you are basically a construction contractor, you have a different set of laws than a regular retail business. So that's why we separate these classes out, hopefully trying to make it a little easier to understand. Now, just need to let you know, just by attending this class does not flag you for an audit. And also that whatever I tell you today, it's not binding to the Department of Revenue, which ought to just give you all the comfort in the world on everything I'm telling you about. And I don't blame you. It's actually not just me, it's every representative of the Department of Revenue. Simply because I'm telling you in generalities, and I would have to know every single detail of your situation in order to give you an accurate taxability answer. The truth is most answers, the answer to most questions is it depends. I mean, that's sort of the running dialogue around here. Well, it depends. There's so many different factors. One thing could change the taxability of something. But there is something that does allow you to have a binding answer for your records. Of course, we have notices, and those are published on our Department of Revenue website. Also revenue rulings, but there's also something available most people don't know about. It's called a private letter ruling. And so what that's designed for is for you to write in. First of all, you have to be a business. So not just anybody can write in for a private letter ruling. They have to be a business, so be in business. So you must have a sales tax number, and you must be writing about something that is actually and factually happening. So it's not, we won't answer hypotheticals. If you ask as a hypothetical, we'll basically refer you to a publication because it is binding. So, but if you have this question, this is exactly what is happening. I need to determine if this is taxable or not. Well, you're gonna want to put as much detail as possible because we will only answer the question asked, sort of like a computer, I guess. What information, that's all we will answer. So I try to tell people what you want to do is try to think ahead a little bit, which that's hard to do because sometimes you don't know what you don't know. But if he answers yes to this, then what? Or if he answers no to this, so it's not a one-shot deal though. So you could write in again, but sometimes I recommend people to write for a private letter ruling simply because I could see that the answer could be interpreted a couple different ways, and to protect a business, I could see them needing that in their record just for their peace of mind. But not everything is that way because there are some pretty clear-cut things. But the best way to get a private letter ruling is to email in for it. So the general email for the Department of Revenue, I have that up on the screen. Hopefully everybody can see my screen. It's at KDOR_TAC@ks.gov. So that's the general Department of Revenue email. So if you email that, that's just going to the general email. So you're going to want to, in this subject line, put request for private letter ruling. And you'll also want to put attention, policy, and research, or you could put attention P and R. That way it gets directed to the exact right department. And statute says it takes
5 minutes. Being recorded.
Oh, did everybody else's mine just disconnect and connect? Can everybody hear me? My Zoom thing said this meeting disconnected, and then it said connected. I'm not sure. Oh, wow. It froze. It just got disconnected. Okay. All right. Well, it looks like it's working again. Okay. Sorry about that, guys. Maybe I'm being censored. I said a naughty word. I said tax. So I think I'd censor that too. All right. But the if you have want to write in for a private letter ruling, that's the email that you have. And by the way, a question I get a lot of times about these slides. I'm going to send those into the Small Business Development Center to share with you, and they'll be on a PDF. They don't have our latest slides, and I'm terrible at updating them with that, so that's my fault. So I apologize for that. And if for some reason you don't get one, you're welcome to email me, Roger, or Margot. There's 3 of us that do this, and you're welcome to email any of us. So this is where you would get a private letter ruling. So maybe you have learned one thing, which that's a pretty good deal. I always say if I learn one thing, I can go back to bed. But trouble is, I'm getting old, so I forget 2 things, have to stay up. So I'm just stuck. All right, well, let's talk about sales tax for construction contractors. I already told you that it's different than a retail business. A retail business, they really have it much easier. What they do is they buy what they're going to.
Carl, could you please share screen again?
Oh, I'm not sharing my screen. Oh, thank you. Yeah, me and technology. Can you guys see that now?
Yeah, perfect.
All right. Sorry about that. I'm just pointing at stuff that isn't there. So, okay, there we go. Yeah, I'm not sure if you guys seen the slide there for the private letter ruling. I'll leave that up just a second there. It's the KDOR_TAC, and then I'll go to this next one. But for retail business, they have it easy. They buy what they're going to sell without sales tax. And then they collect sales tax on the final cost to the customer. It's called gross receipts, the gross amount, which means the total selling price. The whole idea in Kansas is to have sales tax paid one time by the final consumer. And that's when everything goes just right. So that's the whole idea. By the end user, they want the end user to pay the sales tax. And when everything works, it's only paid one time. So everyone before that should be buying it without tax. And there's methods in which to do that. Well, what's different about contractors is, first of all, with a retail sale, we just consider that one part of a contract. They're just selling it, that's done. Well, for construction contractors, there's really 2 parts to a contract. There's the physical materials that you install, the wiring, concrete, conduit, pipe, that type of stuff. And then there's the labor to install it. So there's materials and labor. But for calculating sales tax, here's the way we look at it. If it's not the physical materials, it's going to follow the taxability of the labor. So what I tell everybody, if it's not the materials, it's the labor. We're cavemen. We can't handle large concept with these big words that you guys have. You guys may call in and say, well, is this taxable? So we're going to say, well, is it the physical materials? Well, if it's not, then it's going to follow the taxability of the labor, and we'll look at that. And then, so you guys have words like markup and overhead and delivery, and um, what a COVID-19 fee, gas surcharge. These are all part of gross receipts. So those aren't physical materials. If those aren't physical materials, that means they're going to be labor and they'll follow the taxability of the labor. So that's for sales tax purposes and when you're calculating that. So if you see there, I just got your basic example. Show a contract price, $9,000. So show tax paid materials, $6,000. Whatever's left, that's labor. That's really what it boils down to. Now, I have oversimplified everything, of course, but really that's how you calculate your labor. If it's not the physical material, it's all going to follow the taxability of labor. It's going to be labor. So you don't have to do calculus or trigonometry or anything. In fact, I always tell everybody, I'm no good at math. That's why I went into taxes. If I was any worse at math, I'd do federal taxes. So I'm sorry, I got nothing but bad jokes, guys. So I'm going to go over that materials first, and then I'm going to go over the labor, and then I'm going to combine them and smash them together. You guys have questions along the way, let me know. I'll try to look there. I'm not super great at reading the messages when I'm doing this, but I'll do my best. But we'll get your questions answered all along the way. Okay, so the first part is materials. Now, I just told you that in Kansas, the ideal situation is to have sales tax paid one time by the final consumer, the end user. Here's the part that usually makes a contractor fall out of their chair. A construction contractor is considered to be the end user, the final consumer of the materials. So someone hires you to do this building, this construction project. When you buy the materials, the state of Kansas says you're the end user, just like you're buying them from yourself. Well, how do they come up with that? Well, where the distinction comes in, first of all, you are working on real property. So remember, real property is real estate, permanently fixed buildings and land. Real property. That's different than tangible personal property. So let me give you an example. Tangible personal property is you take your car and get it fixed. Well, they're working on tangible personal property, not real property. You're working on a house, that's real property. So when you're working on real property, that's when you follow the construction contractor laws. Remember, the contractor installs or applies the materials into the real property. Okay, first of all, need to realize there's no sales tax on real estate. So when you buy a house, you don't pay sales tax. Now, we all know you pay property tax, but you don't pay sales tax. So as a contractor, when you install or apply that tangible personal property that you purchased into the real estate, into that real property, the second you install it, you are turning it into real property. It no longer exists in this world as tangible personal property. That also becomes the exact moment that you became the last person to buy the tangible personal property in the format of tangible personal property because you changed it into something else. So what that means is you meet the definition of the end user of the materials. Therefore, you owe the sales tax on the materials. So as a construction contractor, your customer should never see any sales tax on the materials ever, no matter what kind of job. Your customer should never see sales tax on the materials portion, never. Now, so a contractor is supposed to pay sales tax up front when they buy their materials. Simplest way. There's another designation, you'll see it sometimes called, see, retailer contractor, you'll see it sometimes called contractor retailer, same thing. What I want you to gather from that is what that is designed for is a business that's primarily a retail business. They're mostly a retail business. That's mostly what they do. Retail means they don't install it, they sell it. So that's the distinction there. So you can think of some of these big businesses that probably would qualify for this, you know, those orange ones and blue ones and green ones, you know, you go there, you can buy all the materials. They're usually DIY centers, but they also offer, hey, we'll install that water heater for you. Well, when you buy it and you take it home and install it yourself, that's a retail sale. They did not install it. Remember, retail, they buy it without tax, collect tax on the gross receipts. However, when they install it, now they're acting as a contractor. Well, the law says that a contractor retailer contractor, that they buy all of their materials. They buy all their inventory without sales tax. So are they getting out of paying sales tax? No, they're not. Actually, it's more bookkeeping is what it is. They take the scenic route and do it. So whenever they act as a contractor, whenever they install that material, they will need to pay, so they owe sales tax on that material. Well, they buy all their inventory without tax. So how they do that is if they act as a contractor on their next sales tax return, they will report the amount that they paid for that material, their cost, on a line on the sales tax return. It's called merchandise consumed. So that way they will pay sales tax for that material on their sales tax return. They don't get out of paying sales tax. I always tell everybody they take the scenic route. It's more bookkeeping. It's a lot easier to pay sales tax upfront, keep your receipts. The bookkeeping is a lot easier. So, but I have a lot of contractors who say, well, that's not fair, but actually it's way easier if you're just a contractor. Then there's those that are somewhere in between, and that's a whole different story. But so what is a contractor retailer? Well, they stock a normal inventory. They have a showroom floor. You can go shopping there. So it's not, well, every now and then I'll sell a part to another no, well, that you're not a retailer, you're a contractor. So now, part of my presentation there is I show you, we have a regulation that talks about construction contractors, 92-1966, and I kind of highlighted some areas there. What I wanted to show you is that it literally says there that the contractors, subcontractors, and repairmen are deemed to be the final consumer of materials. It also says that a contractor, subcontractor, and repairman shall not use a resale exemption certificate. That means they can't buy their materials without tax and act like a retailer. Also, since a contractor is the end user of the materials, even if you have a job outside of the state of Kansas, if you pick your materials up in Kansas, you buy them here in Kansas, pick them up in Kansas, you still have to pay sales tax on the materials, even though they're going into a project outside of the state. So that's one, when contractors audited, that will really bite you. Also, the state of Kansas does not recognize other states' project exemption certificates. So it may be an exempt project in another state. That doesn't matter when you buy your materials in Kansas, because you're basically in the jurisdiction of Kansas. Our laws are good here. Our laws are no good in any other state, and the other state's laws are no good in Kansas. So that's why. Now, what rate of tax do you need to pay on your materials? Well, Kansas is destination sourcing. Just kind of a fancy word that means that the rate of tax that anyone pays, whoever's the end user, whoever's going to pay the tax, they pay the combined state and local sales tax rate that's in effect where the end user takes delivery, where the final consumer takes delivery. It could be where you pay for it. I go to the store, pick it up, I'm taking delivery of it right there. But it doesn't necessarily mean it's where I paid for it. So if I go to Nebraska Furniture Mart up in Kansas City, I pay for a recliner, I tell them, hey, deliver it to me in Topeka. They'll be collecting the Topeka rate because that's where I'm taking delivery of it. Why am I telling you this at all? Well, here's why. First of all, I'll sort of answer that with a question. What did I say about the contractors at the very beginning? Who is the end user of the materials? Yeah, the contractor. So if a contractor is the end user of the materials, the contractor owes the sales tax rate on the materials where they take delivery of the materials. Could be the same rate as the labor, if that's where you take delivery of them, or if it happens to be in the same jurisdiction. But here's the thing, it's not necessarily. So keep that in mind. We've had a lot of contractors where that will bite them as well. But here's the thing. I always tell everybody, use something that could possibly be a negative and turn it on its ear and make it a positive, especially if you're in the Wichita area. Because Wichita, the city of Wichita itself, normal sales tax, 7.5%. Most anywhere else in Kansas, most of the places in Kansas are much higher than that. So what I'm saying is if you owe the sales tax rate at where you take delivery of the materials, you can use that to your advantage if it works. If you're able to take delivery of your materials in Wichita, keep your receipt. That's where you took delivery of it. That's good. You owe sales tax at 7.5 instead of like 9.15 in Topeka or outside rates. So I've had a lot of contractors come to my class and tell me that they use that to their advantage, and there's nothing wrong with that. There's nothing illegal about that, by the way. Because the law says you owe the sales tax rate in effect where you take delivery if you're the end user and you're the end user of the materials. So use that to your advantage. So the thing is there's a lot of jurisdictions in Kansas. I don't even know how many. The last I knew there was 900, and then it was like over 1,000. So I think there's more than that. But how do you find out what the sales tax rate is? Well, the best way is to go to the Department of Revenue website, and we have a lookup page. On the very front page, if you scroll to the bottom, there's an area where it says tax rate lookup. You go there. What you're going to want to do to get the most accurate rate is to include as complete an address as you can put in there. And in fact, we have a statute that talks about that. If you put in a complete address, and that means you have done your due diligence. If we were to give you a wrong rate, you're protected by statute. It gives you this request number, and which is like a confirmation number. So what is your due diligence? Well, put in as complete of address as you can. Well, that means the address, the zip code, and then if you can get that +4 on the zip code. And where do you get that? Well, if you go to the United States Post Office web page, that's the only place I would go. I wouldn't go Googling that because that'll get you all kinds of spam and stuff. So go to just the United States Post Office website, type in the address, it'll give you that +4. You type that complete address into the lookup page, it will boil it down to the spot. And the reason why you do that is because some jurisdictions are literally right next to each other. So there's the Legends area up in Kansas City. There are businesses that each business is a jurisdiction. So you need that +4 to know and they have different rates, by the way. So that's why it's important. So you don't ever want to, not put that in because it's just going to, what's the most used rate or something like that. It could be an inaccurate rate. And in an audit, that's not really a good thing. So you do your due diligence, you're protected, print that off, write down that number. Also, if you're using software, if you contact our electronic people, they could take your software. And I believe on most software, they can link it up to our system so that whenever you're typing in a sales tax rate or jurisdiction or whatever, if you're doing that on your computer system, it'll just go to our website. It'll actually capture that request number, and you're getting the most accurate rates. I always tell everybody you might as well go there, because if you're using someone else's program to look up our rates, where do you think they're getting their information? If you're using theirs, you're not covered by statute. If you're using ours, you are. So why wouldn't you do that? I mean, you can even do it, like I said, through the software. Here's another thing that happens to contractors. They'll get audited, and then they'll find out, hey, there's something called Compensating Use Tax. And they'll say, what the heck is that? And then the auditor has to explain to them, hey, this tax is for stuff that you are considered to be the end user of, and you have purchased that stuff outside of the state of Kansas and didn't pay any sales tax on it, or you paid an amount less than the Kansas combined rate of sales tax, or someone you ordered it online came from outside of the state and they just didn't collect any, something like that. You owe consumers compensating use tax. So if you buy something you're the end user of and it comes from outside of the state, you use it, store, or consume it inside of the state, haven't paid any sales tax on it, or haven't paid an amount equal to or greater than our combined state and local sales tax, you owe consumers compensating use tax. When do you think this came about? Most people think, oh, when the internet happened. Nope, 1937. When they had the imposition of sales tax, they had the imposition of compensating use tax. Every state that has a sales tax has a form of this, and it's been around that long. Without it, if you think this through, I could make some large purchases in another state, have them delivered to me in Kansas, take delivery. I wouldn't owe any tax if it wasn't for this. So now you know why other states have that. Now, you used to be able to report as an individual all of your personal compensating use tax on the income tax return. Because, yeah, it's not just businesses that owes this, it's you and me if we buy something outside of the state and we didn't pay enough tax. But the statute, well, the legislature, they took it off the income tax return. This will be the first year it's been off of the income tax return since 2003. So once, if you make those purchases, you'll have to file a sales tax return as an individual. So we'll see if that happens. But what kind of things would you owe compensating use tax on? Well, materials. Remember, you're the end user of materials. That's one thing. So you definitely want to keep all of your receipts for your materials. Make sure that it shows enough. Also, your tools and equipment. You want to definitely keep the. They'll ask, well, can we see the? Make sure you paid sales tax or compensating use tax. A lot of contractors find out there's something called compensating use tax when they're audited, and we have been accused of making that tax up. I just want you to be aware there is something that is called compensating use tax. If you are not making purchases outside of the state and are not making anything that qualifies for compensating use tax, there's no sense in registering for a compensating use tax number. You don't need to file any more tax than you absolutely have to. But if you are, then you'll have to register and get a compensating use tax number. So you're either going to pay sales tax on materials or compensating use tax. Wow, I've just browbeat you about that tax on the materials. If you go to another state, you are going to be subject to that state's laws because now you have what they call a nexus, which would be a presence, a significant presence, a significant connection for that state to require you to collect sales tax on anything you sell in their state. It's sufficient. So there is economic nexus now. So a physical presence is not even required to allow a state to require you to collect their tax. However, most states have a threshold based on a Supreme Court case in 2018 that was South Dakota versus Wayfair. Usually the amount is around $100,000. So usually the language would say something to the effect if your gross sales into a state exceed $100,000 in a calendar year, or like South Dakota there says, or if you have 200 transactions in a calendar year, they'll require you to collect their sales tax from that point forward. So if you ever have economic nexus or breach that threshold, no state will go retro. They won't go retroactive on that. They will only go from that point forward. So just letting you know. That was one of the things that the Supreme Court stressed in that particular case, and that's what everybody's following. And that's true in Kansas. So if somebody meets our threshold, we have that threshold, $100,000. So it actually says if you exceed $100,000. So if you're a remote seller, that would be your taxable and non-taxable sales. We will then require them to register, collect, and remit our sales tax. So just wanted you to be aware of that. Physical nexus still applies. That means, well, I own or rent real estate in a state. I deliver whatever I'm selling with my own vehicles or own company vehicles, or I have a representative doing business on behalf of my business in that state and my company. So those things still apply, but also in addition to that would be the economic nexus. So just letting you know. All right, I browbeat you about those materials. I'm sorry about that. Well, now I'm going to talk about the labor. So what I try to tell people is I'm going to tell you the rule of law, I'm going to tell you the exception to the law, and then I will tell you the exception to the exception. Now, everything I've been talking about is we have a publication. It's called the Sales and Use Tax for Contractors, Subcontractor, and Repairmen. And in the lower left-hand corner, the publication number is KS-1525. So if you're ever wanting to look at this publication, if you go to the Department of Revenue website, in the search field, if you type in KS, got to have that dash, 1525, it'll pull down a menu, and you get a click on this, and you can either look at the internet version or the PDF. I prefer the PDF version. But this, we are updating these, so you might stay tuned and look at the revision date, that type of thing. But everything I'm talking about is in these publications. So first thing is, general rule of law is you pay tax on materials and that's any kind of job, and then you collect sales tax on the labor. That's the general rule. Now, there are some things where you're not installing or applying, therefore that service is not a taxable service. That would be things like mowing lawns, raking leaves, backflow testing, just testing in general, drain cleaning, cleaning. Exception to cleaning would be it actually enumerates, specifically lists washing and waxing of automobiles. It specifically lists dry cleaning. It's actually triple tax, sales tax, chemical tax, and then excise tax. I always tell everybody it's like starch. They're stiffly taxed. And laundry services, that's the exception. Of quote, laundry services are taxable. Exception to that are coin-operated laundry machines. So that's an exception to the exception to the exception. Whew. No wonder this is so hard, huh? All right, so if you're doing nothing but testing, so let me give you the example I like to give. I was actually in Garden City. If all I do is test, that's not a taxable service. So I had an electrician, I was talking to him in Garden City, and he got a call from a gal that owned a bakery, and she had an outlet go out. And it was around Christmas time, and she said, "Hey, I need that outlet to work. We're humming. I need to get stuff going. You need to plug a mixer in or something. I don't know. I just eat the stuff. I don't know how to make it." But so the electrician says, "No problem." And he said that we have an $80 trip charge. And basically, I guess that means that he charges $80 just to show up, even if he doesn't do a thing. And she said, "I need it working, so come on out." So he said, "Okay." So he goes out there, gets to her bakery, goes in the basement where the panel is, the breaker panel, checks all the breakers. Then he checks the wiring, has the equipment to do that. Then he goes up and checks the receptacle itself. Everything tests fine. In fact, what happened was she overloaded the circuit. It's a 20 amp circuit. She overloaded, plugged way too many things in, 15, 20 things, just Christmas treed out. Unplugged, he said, "You can't plug that many things into there." So all he ended up doing was testing. He didn't install a thing. No tax. So there's no sales tax on that because he did not install anything. So he said that was a great deal. $80, no sales tax, and she also gave him cookies since it was Christmas time. Can't beat that. Okay, so you got that where if you're just doing that testing, same way with cleaning. If you're just cleaning a drain out, getting a clog out, that's just cleaning. And when I say these things, if you notice that was a commercial building, so it doesn't matter where it's at. It's just not a taxable service. But what I'm telling you now is very important. It's called gross receipts. So here's what I mean by that. So that testing, we're going to change that scenario for that electrician. Instead of him testing it out and nothing is wrong, let's say he tests that out and finds out that outlet, that receptacle's bad. So he has to replace the receptacle to fix it. Well, he buys those things by the gross, and $2 a piece. Sells them for 10, who knows? But so he ends up getting a receptacle, puts it in, fixes it. Well, because of the law of gross receipts, the law is the definition of gross receipts. In fact, in 793602, which is the statute, it says that any consideration, the total selling price is what's taxable. So since he installed or applied, he now will need to collect sales tax on the whole bill to the customer, the gross receipts. In other words, he had to sell that $2 receptacle. He charges $80 to show up, but he has to collect tax on the whole thing. He cannot separately state or separately invoice the testing on that. And in fact, the repair was done because of the testing. That's how he found out he needed to do that. So that's where I want you to understand that gross receipts is very important because that could affect the job quite a bit. Now, I'm going to confuse you here. I don't mean to, but here's what I'm going to try to do. What I just said, that's for testing. Same thing with cleaning a drain out when you're getting a clog out. That's basically cleaning a drain. not a taxable service unless you install or apply something. So if it's in conjunction with any of that, the whole thing becomes taxable. Okay, hang on to that thought. Put that in a separate filing drawer of your brain. I want you to open up this filing drawer, and nothing's in this filing drawer right now, not a thing. And on the front of that filing drawer, I want you to label it excavation. Can you dig it? Hopefully you can. And I got nothing but bad jokes. Excavation is different. Excavation is not a taxable service. You dig a hole in the ground, fill it in with the dirt, not a taxable service. What is excavation? Well, digging. If you're grading, moving dirt, that's all part of excavation. You're not installing or applying. Okay. It's different than that cleaning and that testing that I was just talking about. You are able to separately state or separately invoice the excavation portion of a job, and it will remain non-taxable. So long as you separately state it. If you don't separately state it, it just becomes part of those gross receipts and it'll be taxable on a taxable job. So let me give you an example. Let's say we're working at an existing commercial business and they hire us to come out and dig a trench because they're going to be putting in some wiring or plumbing or something. So we go out and we do that digging in the trench, no tax. And they say, well, we need you to line that trench with some gravel. So we go buy our gravel, remember, materials. So, okay, we pay tax on those materials. Now we're installing them. We'll collect tax on the installation of that. And then we're going to fill it back in with the dirt. Well, that's just part of the excavation. So I'm able to separately state that excavation portion and it would not be taxable. Only excavation. Don't let anything else fall into that drawer that we opened up there. Only excavation. For now, anyway. So that's what gets a little confusing. So anything else, gross receipts. Hopefully you guys will come back before next July because I'll have more things that will actually act just like what I talked about, but they will not take effect until July 1st next year. Because it's one thing, I'm not sure what kind of contractors we have here. Are there any dirt haulers or anyone who does like a lot of hauling, that type of thing? If there is, you might want to talk to me because what is going to happen is July 1st next year. In fact, the statute says basically, it says that hauling, or not, it doesn't say hauling, it says delivery. Well, what is delivery? Delivery is the same thing as shipping, hauling, that's delivery. That it's so long as it's separately stated, it will not be taxable. Again, that doesn't take place until July 1st, 2023. So it's still taxable as gross receipts right now. So that's why I don't have a slide for that. I don't want to confuse you, but that's why I'm saying come back next year because we'll see if the legislature tweaks that in any way, shape, or form, and maybe we have more definitions. But if you are a company that does like gravel hauling and stuff, where that's a huge part of your tax bill, your business is going to change, your tax bill. Well, so here's what I'm saying. You already charge this amount because it's taxable. Well, if that becomes, that portion becomes not taxable, so long as you separately state it, well, that means you could actually make more without doing anything more. You just don't, you separately state it, won't be taxing that portion. In fact, you could actually, it's one of those cases where you could actually charge less and make more. You're just charging less than you normally do, but because you don't have to collect tax, you still make more. So stay tuned to that because that is going to be a big deal. Oh, Tanya, excavating. All right. All right. Do you get to drive the excavator? No, my wife won't let me do that anymore, but I sure want one. I don't know what I'd do with it, but dig holes, but I sure would do it. Okay, so I got that slide twice, don't I? Or I went backwards. Anyway, so now There are a couple exceptions to the labor for the sales tax on the labor. And the first one I'm sure most of you have heard about, and it's basically what I'm saying is you're still paying tax on these, but there's no sales tax on the labor portion if the job is residential. Okay, well, what is residential? In the statute basically says, well, it's a place where somebody customarily lives. Okay, do people customarily live in houses? Yeah. What I want you to notice is I didn't say, well, it depends on who owns it. Nope. Does somebody customarily live in that structure? That's what we're looking at. Well, with that said, what about a mobile home? Yes, but there is a caveat to that. So long as that mobile home is a mobile home or manufactured home, whatever they call them now, and it's permanently affixed, it's hardwired, hard plumbed, fifth wheel wouldn't qualify. It doesn't matter if you put that on a concrete pad. In fact, its property tax portion is all tangible personal property. So mobile home, as long as it's hardwired and hard plumbed. Another one that'll get you, might surprise you, is apartments. The living units, the individual apartments are considered to be residential. So if, let's say you work on an air conditioner, it's for a unit, a resident, that's residential. The common areas would not be residential. So if you did something that affected the whole thing, you'd have to come up with the total square footage compared to commercial compared to residential and apply that percentage to the labor. If it's a big enough job, that's worth doing. I've had some contractors say, I just collect tax on it because I don't have time to figure it out. Okay, well, that means you've overcollected. And so the law says if you've overcollected, you must either refund it back to the customer or remit it to Kansas. You can't keep the difference. So some contractors do that. I don't advocate it, but I understand it. Time is money. And if they, like a lot of them do not have a department that does this. They are it. And many of you may be in that situation where you're not only the person running the excavator, but you're also the accounting department and whatever. So I totally understand that. So residential, a nursing home, it's just very similar to the apartment, except here's the difference. The nursing home, only the sleeping rooms and any bathroom that's in that sleeping room. Everything else is going to be considered commercial, the dining area, all the open areas all outside. So only the sleeping rooms would be considered residential. Hotels are what they call transient, so they would not qualify as residential. So just letting you know. So I think you kind of know residential now. Also part of residential is not just residential, but the immediately surrounding area. So I get that question a lot. And with residential, it doesn't matter if it's a remodel job, by the way. Is it residential? That's the thing. It doesn't matter if it's an existing residential or is it residential, no problem. Residential, that's why there's no tax on the labor. That's why it's exempt. It's the next one is where you start looking at stuff. So residential, we got that. The next exception, many of you might have heard this and probably know one definition, and there are 5. This is called the original construction, but it's only original construction of a building or a facility. That's it. So what's a building? Well, it's basically a structure that houses people and property. That's what a building is. When it talks about that, it's a structure. Well, that means if it's a structure, it has walls. So that should answer a few questions there. What's a facility? I put that right out of statute. It says a mill, plant, refinery, oil, gas, or water well, feedlots, and then the distribution lines that are owned by rural electric co-ops and cities. So it's the electric co-op and city electrical distribution lines. That's it. So not just every distribution line, just those, because it specifically lists those in statute. So if it's original construction of a building or facility, there's no tax on the labor. Well, what is original construction? Told you there's 5 definitions. I'm not sure if you guys have this, but definitions, they start on page 6. And the first definition is the first or initial construction of a building or facility. That's the one most people know. They call it new construction because it is. It's the first time something's built. Pay tax on the materials, no tax on the labor. And by the way, there is no exemption certificate for residential. There is no exemption certificate for original construction. Okay, that can be a challenge. Now, residential is not bad. All you need is an address. Keep that for your books. But for original construction, you're going to have to keep something in your records. The reason I'm telling you is because the burden of proof that something is not taxable is on you. The default in Kansas is that everything is taxable. I mean, in layman's terms, it's 793603, which is the imposition of sales tax. In layman's terms, it basically said for the privilege of engaging in business in Kansas, you must register, collect, and remit sales taxes. Basically, in a nutshell, what it means. Basically, it's saying it's a privilege to do business in Kansas, to sell in Kansas. It's not a right. So before that privilege, you must collect sales tax. So with that said, it says default, it's taxable. So heaven forbid you're audited. Auditors coming out there in their eyes, it's like everything's taxable. Show me something that would make me think that that's not taxable. So that's what I tell people. You're going to keep your records to show that I have collected or paid tax on everything I was supposed to, or I have a good reason why I don't in my record keeping. So residential, I got an address where that happened. Original construction, well, building plans work. You know, if you're doing original construction of a brand new building, you should have a copy of the building plans or something like that. That's the first definition. Second definition, if you notice the second definition, you can almost hear somebody asking this question. But the second definition says, well, an addition of an entire room or floor to the exterior of a commercial building. Now we're saying commercial, right? Because if it was residential, well, it's exempt because it's residential. Remember, it doesn't matter if it's existing residential or new residential. Is the labor exempt? Yes. It doesn't matter what kind, but we're talking commercial now. So commercial, no tax on the labor if it's the first or initial construction of a building, commercial building or commercial facility, or the addition of an entire room or floor to an existing commercial building. Now, the key to that definition, and you might want to write this one down. I need to put that in the book. It must be adding square footage to qualify. So that's how we know that, well, this is original construction. So we're knocking out a wall. So if I hire somebody to come in here and put a wall down the middle of this room, that absolutely is new construction. It's not original construction, though. All they did was take this space and divide it into two. Okay, so but if I come in and say, hey, knock out that wall, we're going to add an addition. Well, now we are adding square footage. That's original construction. So now I'm still paying tax on my materials, but no tax on my labor. And in fact, it talks about, well, if there's anything that's required to complete this original construction job, and this is happening in the existing building, if it's essential and required to complete that job, it will be considered part of the original construction as well. No tax on the labor. So something that would qualify for that is, let's say that we have the electrical room in the existing building, and we have an electrical panel in there, but it is full. So we're going to add another panel so that we can run electricity to that original construction, to that new addition we're putting in. Well, that's essential. Yeah, we're doing the job in the existing building, but since it's essential and required for that original construction, it'll be part of the original construction, and it will be no tax on the labor. Still going to pay tax on my materials. Next definition is the weirdest one, by the way. And I actually ought to just put weird by it, but it's kind of interesting because it talks about, well, the completion of any unfinished portion of an existing commercial building. That's kind of vague, but here's what we're talking about. We're going to call something original construction, but it's not going to be happening at the time of the original construction. It's happening later. And it says, well, okay, so you're going to be doing this work. We're going to call it original construction. Won't be happening at the time. So we have this criteria that you got to meet. You have these 4 things that has to meet in order to qualify for that. So in that book under number 3, I have them listed here. So the first one says, well, was the work called for in the original blueprints or work plans? This is not an afterthought. It was always called for. It's always planned, and it's in writing, in plans, that this was going to happen. Okay, so then the next, that's 1. 2 says, well, the completion of any unfinished portion is within a reasonable requisite of time of the original construction of the when this should have taken place. Reasonable requisite of time. What amount of time is that? Case by case, unfortunately. I can't tell you, well, it's this amount, it's 6 months. Well, it's going to be depending on what size of job. Sometimes there's circumstances that could have caused the delay. You know, you could have been, you know, a job normally, you would have had this done a month after, but a tornado happened and now it's 9 months later. So, you know, different things, case by case. That's the second criteria. The third one is, well, the owner or occupant of that space, that they are the first the first or initial owner or occupant of that building or facility or that spot. They're the first ones that ever occupied it or owned it. And then the last one is that the work would have been performed at the time of the original construction, except for circumstances beyond the owner's control. So things that beyond their control, well, I already named one, that would be weather. Things like, in fact, we have a little note in our publication that says circumstances beyond the owner's control include unavailability of materials, weather, death, or bankruptcy of the contractor. They do not include instances where the owner merely falls short of funds or when, after taking possession, contracts for additional services. So right now there could be somebody not able to get materials. Well, that's not their fault. That's different than, well, I'm waiting till I can afford the materials. There's a difference. So let me give you an example of this, when this would come into play. Let's say we're going to build we're part of the construction to a strip mall. So it's just, I mean, that's a little one. It's going to have maybe 5 or 6 separate slots, separate businesses lease this spot, just taking place on a block or something. So they have all of these spots leased out and done except one. And so one spot, the owner has it advertised and wants to lease it out so that he can, you know, make money on that. So let's say a year goes by, possibly even a year and a half. Finally gets this call and they're going to put in some kind of new business. So I keep telling everybody, you know, Patrick Mahomes Whataburger, I don't know, but let's just say it is a Patrick Mahomes Whataburger. And so they're going to put their business right there. Now we're going to hire you to do this. You're going to make this generic white box look like a Patrick Mahomes Whataburger. That's what we're hiring you for. That's your job. Okay. Well, since you came to class, you're going to just stop for a second and say, well, is there any way this can be exempt? This sort of reminds me of something. So you're going to look and see if it meets all of these 4 criteria. Okay, the first criteria, the work was called for in the original blueprints, building plans, or specification. Well, yeah, it was always planned that a business be in there. So this is not an afterthought. So you can check that one off. Number 2 says the completion of an unfinished portion is within a reasonable requisite of time of the original construction. For that scenario, year and a half, that's a reasonable amount of time. Yes, check that one off. Number 3, the owner or occupant is the first or initial owner or occupant of that, of that space. No one's ever been in there. So yes, you can mark that one off. And then 4, the work would have been performed at the time of the original construction, except for circumstances beyond the owner's control. He had it advertised. He had no control of how long it took to get someone in there. So you can check that off. Check, check, check. Wow. That means that's going to qualify for original construction. That means you're going to pay tax on your materials, but there's no tax on your labor. That means your competitor probably doesn't know that. And I say that because I'm pretty confident of that, because I hear that all the time. They didn't, in fact, they're going to say that's a commercial job. That's taxable. That's taxable. The only reason I tell you that is you can use that to your advantage, in that this is another one of those scenarios where you can, let's say we have a sales tax, we're dealing with a sales tax rate of 8%. This is a scenario where we can charge the customer less and we are still going to make more than we normally do. The reason why is because we have 8% that we know we can deal with, because we know this qualifies as original construction. My competitor, all they see is commercial and they're going to tax it. Okay. You basically, since you kind of know this, you basically charge 4% less than you normally would. But you're still going to make 4% more than you normally would, because there's no sales tax. So you can use that to your advantage. That's a great, I've had people actually from the Wichita area tell me that they've been doing that. So now it doesn't work if your competitor knows about this too, so I can't help that. But you'd be surprised how many people don't know about the sales tax. So that's 3 definitions. The fourth one, very similar as far as what can happen for you than the last one we just talked about. The fourth one, if they hire you to do the repairs, to do this work, and it's because of damage that was caused by fire, flood, tornado, lightning, explosion, ice loading, attended winds and windstorms, terrorism, and earthquakes. So attended winds and windstorms, that's wind speeds of 80 miles an hour or more, which is very interesting because that happens quite a bit in Kansas, and that's 5 miles an hour greater than a Category 1 hurricane, or what I like to call Thursday in haze. The flood, and I'm going to define flood for you. It's a natural flood, so it'd be torrential rains, overflowing of river, streams, and lakes. It would not be a broken pipe, flooded a basement, that type of thing. Ice loading. That's not, again, that's not frozen pipes. That's not anything like that. Ice loading is a industry term for the electrical overhead wire industry. So the amount of ice that accumulates on those electric overhead wires is called ice loading. And they added that one a few years back when there was a bad electrical storm up in the Kansas City area. Lightning, okay, that's shocking. So we know that one. But one thing I want you to recognize that is not in here. Now, tornadoes in there, but hail is not in here. So hail, no. Hail, no. That's how you remember it. So explosions, you know, when they added that one was when Hutchinson exploded. I don't know if you guys remember that, if anyone does. I think they had a gas leak in one of the mines or something over there. But they had a really bad explosion and fire. So anyway, so let's talk about this for just a second. So let's say we got a McDonald's. Well, we don't have a McDonald's. We're gonna call them. We're gonna give them a bid. What happened was they had a McNugget tragedy. They had a knuckleheaded kid that was cooking McNuggets. He accidentally left a McNugget in the fryer. Caught the fryer next door. It had filet of fish. It's up in flames. Someone had the buns too close to that. Now the buns and the shake machines, the kitchen's on fire. Then the fire suppressant got it out, but the kitchen's total. Now, gonna call you to make this right. Make it look like it's supposed to look instead of melted everything. Now, one thing you need to be aware of that is not original construction of a building or facility is vandalism. So vandalism, one thing that would include is vandalism would be arson. But the reason I tell you that is this is not arson. This is a knucklehead. This is an accident. Sort of like, insurance. They do cover stupidity, but they don't cover someone who does something on purpose. So it's sort of like that. So you fix this. Now, remember, there's no exemption certificate for this, but you have the burden of proof. If an auditor, heaven forbid, audits you, they're going to say, okay, you didn't collect tax on this labor. Why? And you're going to say, well, it was original construction. And they're going to say, well, why? And you're going to say, well, it was a fire. And they're going to say, prove it. Okay, how do I prove it? Well, one thing I cannot do is use my cell phone and take a picture. My nephew can make me look on fire right now, which I have no idea how he does that. But let's take a look. We could use probably there's a copy of a fire report, a police report. More than likely, you will have access to an insurance claim, an insurance document. Now, if this is in somewhere around Kansas and McDonald's is on fire, it's going to make the newspaper, which is going to be electronic. So you are able to, you can cut a picture out of the paper, which I guess now it's cut and paste with the computer because there's hardly a physical one. But if you could save a picture of the article out of a newspaper, that would qualify. If all else fails, you can get a signed affidavit from the owner of the building or the manager, and get it notarized. They would put the date and say this was a fire that was happened on this and this and this. Have them sign it, date it, notarized, put that in your record. Heaven forbid you're audited. That'd be the very last thing that I'd get, but I would get at least that if I can't get anything else. Probably get something else though. You probably could. Last definition is bridge or highway work. So it's to construct, reconstruct, restore, replace, and repair bridges and highways. That's considered original construction. So I'm not, now one question I get of that is like, well, what about a bridge or on a farmer's driveway? Well, no, that's not a public bridge or highway, first of all. So they're talking about a public bridge or highway. So original construction, 5 definitions. Now, I kind of stressed out, if you look at the slide, I have building and facility, not only outlined or not outlined, underlined and in whatever color that is. The reason I have that, and I have it bold as well, because it only counts for a building or a facility. So let me give you an example. Let's say we got a brand new McDonald's going up. Okay, we know that's the first or initial construction of a building. So that's original construction, no tax on the labor. Well, I have a company that, an asphalt company, and I'm going to be putting in a new parking lot for them. Well, since this is in conjunction with this original construction job, there will be no tax on my labor. It'll be considered part and parcel to that original construction job. Okay. Well, here's where it confuses you. Let's say instead of a brand new McDonald's, we have an existing McDonald's, and they want me to build a brand new parking lot next to the existing parking lot because they need more parking. So I'm going to be putting in a brand new parking lot. That is not original construction because a parking lot is not a building and it's not a facility. It's a new parking lot, but not a new building or a facility. So if it was in conjunction with the original construction of a building, yes, I could qualify as original construction. But if it's a standalone parking lot, brand new parking lot, no, because it's not a building or facility. So that's very important. That's why I'm kind of stressing that one. So when is the labor taxable? Well, what we're going to do is we're going to reverse engineer residential, and we're going to reverse engineer original construction. I'm going to call all 5 of those definitions. I'm just going to call that original construction. But when I say that, I'm meaning one of those 5 definitions. Okay. So residential and original construction, no tax on the labor. Well, if I reverse engineer that, commercial remodel is when the labor is taxable. What's commercial? Not a place where somebody customarily lives. What's a remodel? It's not original construction of a building or a facility. So I just reverse engineered that. So when I have a commercial remodel job, I have to pay tax on my materials, and then I'm going to have to collect sales tax on the labor. Well, I have a lot of people say, well, isn't that double taxation on the materials? Well, no, it's not. You are going to get your sales tax back on the materials. How do you do that? Well, you are going to mark up your materials. What I mean by that is you got to get your money back. So you're going to charge your customer more for the materials than you paid for them. You have to at least charge enough to recover your sales tax that you paid on them. Hopefully there's enough room to get a little profit too. Well, here's the thing. That marked up portion, we already got the amount we paid on the materials with the sales tax. Not talking about that. From that point forward, the markup portion. Is that portion physical materials? No, it's not. It's a calculation is what it is. Remember I said if it's not the physical materials, it's labor. Basically, it'll follow the taxability of the labor. So I'll have a lot of times people ask me, well, is that markup that I have on the materials, is that taxable? I have to ask them, well, what kind of job is it? Because if it's residential, no tax on the labor, right? Commercial remodel job, well, yeah, then that portion's taxable. So that's what I'm saying with these two little paragraphs I have. First one, it says markup on materials on a residential or original construction job. Well, we know on a residential and original construction job, no tax on the labor. So I said the markup of materials is not taxable. When the labor is not taxable, because Department of Revenue considers markup of materials to be labor, thus if the labor is not taxable, that markup's not taxable. I get really redundant and I say the exact opposite right here where it says, well, if the labor is taxable, now that portion is taxable. So that's the answer to your question. So here's the thing. You don't really want anyone to see the markup on your materials if you can help it. So there's a section in the law that says, hey, there's two ways to invoice a customer. One is you itemize and show the sales tax. We're used to that if we collect a receipt. Just show it on there whenever you go out to eat. They give you, well, most people don't take one anymore, but if they give you a receipt, it's on there. But there's another way where you don't have to show any sales tax at all. And there's I put the statute on there too, 793648. But it says if you don't have to show any sales tax at all, so long as you have this language on your invoice, and it's all applicable sales tax included. Now, what that if it were me and I was a contractor, I'd have that on all of my invoices, because what that language means is if what I did for you was taxable, I collected the appropriate amount. If it wasn't taxable, I didn't. And I just tell, oh, I have that on all my invoices. So if it wasn't taxable, I didn't collect any tax on it. Saves a lot of arguments. One question I like to ask people is, if somebody pays you everything except the sales tax, do you still owe the sales tax? Well, the answer is yes. If it was admissible in court that, hey, I can't pay sales tax because they didn't pay me sales tax, no one would ever pay sales tax, first of all. So even if they don't pay you the sales tax, you still owe it. You'd have to go to, and we don't really do much to help you other than we can tell you the law or have them call us, but more than likely, if it's you'd have to take them to court, small claims court, possibly regular court if the dollar amount's high enough. So not fun. So if you can put that language on your receipt, sometimes it saves an argument. But also, you don't want people to see your markup. Now, we were just talking about double taxation. I'm not sure if any of you are a general contractor or have worked for a general contractor, but I don't know if you've ever heard a general contractor say to one of their subcontractors, hey, don't you tax me. I'm taxing my customer. That's double taxation. If they say this, what that tells you is they don't understand how the tax base works for construction contractors. So in that publication, if you get it, I'm not sure if you have it or not, it's about page 18 or so. You'll want to dog-ear that page because there's a little section there that I got in there for sales tax base. I'm not sure if you can see it, but I'll try to put it up there. And here's what I talk about. First of all, what is the sales tax base? All that is out of everything I charge my customer, the sales tax base is the portion that I'm required to collect sales tax on. Well, okay, so What this says is out of everything I charge my customer, I subtract out of that any tax paid materials that I've purchased and any tax paid subcontractors I've hired. The amount that's left, that's what I apply sales tax to. So, okay. So this is on a taxable job. So with that in mind, let's say I'm a general contractor and I'm going to hire you and you're a subcontractor. First of all, I am going to ask you as a subcontractor to invoice me with an invoice that says all applicable sales tax included. That's how I want you to invoice me. The reason I want that is because if you do something wrong on your end for sales tax, that is on you, because I have a receipt that says I paid all applicable sales tax, so I'm good. Now, if I'm audited, I'm good. Anything deficiencies, it's on your end. Sorry. So I want that. But I also don't want people to, and you're going to want that because you don't want to show me your markup. So you're a subcontractor, but really you're a contractor, okay? Sub just means you're working for a general. The general contractor is really nothing more than your customer. So what that means on a taxable job, you are going to pay tax on the materials when you purchase them, and then you will collect tax on the labor from the general contractor. And of course, I already said you're going to put that language, all applicable sales tax included. Okay, now I have my customer. All the rules still apply. So I can subtract out any materials that I tax paid materials, any materials that I purchased that I paid sales tax on. I didn't buy any because I had you do it. And now I can subtract out any subcontractors I paid tax on, which would be you. So whatever you charge me, I subtract that out. Now, when I say to subtract that, I mean just for calculating sales tax. I'm not subtracting your amount on the whole bill to them. I'm subtracting out that in calculating how much sales tax I collect. So after I subtract out what you charged me, I didn't have any tax paid materials. The amount left, so I'm going to mark this up so that I can make some money on the deal. Well, my markup is the only portion I'm going to be collecting sales tax on. So I'm going to give my customer an invoice that says all applicable sales tax included because I don't want them to see my markup. So that's how that works. So that's why I say when you hear a general contractor say, hey, that's double taxation, they're not quite understanding that the portion that's already been taxed isn't in the calculation for the sales tax. And in fact, even a contractor, when they file their sales tax return, they report all their materials that they paid tax on, and in fact, all the subcontractors. It's all in your gross sales. You're accounting for it because you're going to subtract it right back out of deductions. There's not a specific line on that deduction, by the way. It'll be, I believe it's called N, other allowable deductions. So you're showing it and then you're going to back it right back out. So no tax goes on it again. That's how that works. So that's why in your gross sales, you're reporting your taxable and non-taxable sales. But on that tax return, if it's non-taxable, it gets deducted out in the part two. And what's weird is you start out part 3. I always think rocket ship, 3, 2, 1. Okay, so can you ever do any of this with exempt? Is there ways to do this without tax? Yes. Yes, there are. We already talked about a couple where at least the labor portion is not taxable, and that's residential and original construction of a building or facility. Well, there's other things. There's exempt entities. There's project exemption certificates. There's manufacturing and warehousing. That's what the integrated production machinery equipment and warehousing exemption is. And then there's public water suppliers that are paying the clean drinking water fee. Now, I'm not sure if there's anyone here who works on public water suppliers. That'd be like a rural water district or a city water. If they're paying the clean drinking water fee, they will have their own exemption certificate. One of two things: either they'll have a project exemption certificate or they'll have a form. It's an ST28EE. So it's specific to them. If you do, let me know. Otherwise, I'm not going to go too much into that because it's pretty specific. Most people don't do things for them. Actually, for them, it's easy because if they have that certificate, most everything's exempt. So just not too many people do work for them because it's pretty specific. But so let me talk about exempt entities first, because a lot of contractors do work for exempt entities. First of all, what is an exempt entity? I'm not sure if you guys had the exemption certificate book. It's the KS 1520. And remember, you need that dash, KS 1520. But an exempt entity, they're to be considered an exempt entity, you are a nonprofit organization. That's a requirement. However, just because somebody is a nonprofit organization, that does not mean they are automatically exempt from sales tax. That's actually a federal income tax designation. It's a criteria for sales tax, so it's not an automatic exemption. So you have to be a nonprofit organization. You also must be listed specifically in the exemptions to sales tax statute, which is 793606, either specifically listed or qualify under one of the criteria, one of the categories, that's what I should say. So, for example, there one that's specifically listed would be Jazz in the Woods. I'm not sure if you know what they are. They're some organization that puts on a jazz festival at Corporate Woods in Kansas City, in Overland Park, to raise money for a charity. But they're specifically listed. But then you see church, religious organizations, and cities and counties and political subdivisions and universities. So it's not listing out each specific one. They qualify under one of those categories. So that's what I mean by that. But both of those are exempt entities. So they have to be a nonprofit, must be listed or qualify under one of the categories in the exemptions to sales tax statute, and then they must apply to the Department of Revenue for an exempt entity certificate for their exemption to be exempt. So that's what I'm showing you on the slide now is an exempt entity certificate. And they do have an expiration date. The next one will be renewed in October 1st of 2024. They just renewed these in October 1st, 2020. So they do have an expiration date. Now, most of these exempt entities, their exemption is for direct purchases only. In fact, it'll say it right on their exemption certificate, so you'll want to read that. What that means is whatever they're buying exempt, it's only exempt if they pay for it directly. The money comes directly from them. It's not a reimbursement. That's sort of a big deal. So example, let's say I'm a pastor of a church and I'm going to go buy a garden hose to fill up our baptismal or something, or I think that's exempt. Okay, I go to the hardware store. I'm pastor. I have this exemption certificate. So here you go. I'm signing it. Here's my debit card. Church is going to pay me back. We're an exempt entity. Hardware store is going to say, I'm sorry, pastor, I have to tax you. I'm like, well, what are you doing? We're exempt. You're exempt, but only when you do it the right way. You're using your personal card. That's not a direct purchase. That's right. They chewed me out about that. They gave me another card. It's a debit card for the church account. It has the church name and my name on it. It comes out of the church funds directly. Well, that's a direct purchase, so that's a different thing. That's exempt. Or we have a direct billing setup. So I sign this, and then they just bill us once a month. Well, that's a direct purchase. Or we still use a check. So I just showed you how an exempt entity would be taxable. Okay, so let's apply this to a construction contractor. You'll hear construction contract whenever you hear something along the lines of like a real property project or real property improvement. They're talking about construction work, because remember, real property is buildings and land. That means you're working on real property. We're talking about contractors. So on a real property project, if let's say this church is going to hire you to put a roof on there, put a new roof on their church. If this is the certificate they give you, remember, direct purchases. Let's see what this will exempt for you. If I'm the contractor and I'm going to do the work myself, okay, I go to I don't know, maybe I go to Home Depot or somewhere, buy my shingles. That's materials. I'm the end user of materials. Okay, I got to pay tax on that because the money's going to be coming from me. All right. So I do the job and I bill the church and they pay me. Well, now the labor, since they're paying me directly for the labor, remember, if it's not materials, it's labor. So that means that everything else would not be taxable because that would be a direct purchase. That's what would happen if this is what they give me. Well, let's see what happens if I'm a subcontractor. Remember, subcontractor is hired by the general, which means they are paid by the general contractor. Well, none of theirs is a direct purchase. Their exemption, if this is what they get, it'll exempt just like my favorite breakfast cereal, nut and honey, not a doggone thing, because none of it is a direct purchase. So the reason I tell you this is, first of all, if you're a contractor and all you get this, at least it'll exempt your labor. But there's language on here that says, well, for real property projects, if that exempt entity, if that church will apply, usually they'll do it online, apply to the Department of Revenue to get what they call a project exemption certificate. We call them PECs, project exemption certificate. So they apply and then it gets issued. So when it's issued, basically it's an email and they print it off. So here's how that works. That project exemption certificate, what it does is for this snapshot in time. So what they're going to do when they request this project exemption certificate, they're going to communicate with you first of all and say, how long do you think this is going to take? Because they have to put a start date and an end date because it's an estimate of time. Okay, so they're going to put this on with the application for the project exemption certificate. They're going to apply. If it gets approved, no problem. What that project exemption certificate does is it exempts indirect purchases, but only for real property projects. So for this snapshot in time, there's a start date and an end date, only a start date and an end date. Only between those start date and end date will their indirect purchases be exempt for a specific project. So it's only for this particular construction project and only during that time frame, not before, not after. So if you buy your materials before the start date on the project exemption certificate, taxable. Sorry. And that happens. If you buy your materials after the end date on that certificate, taxable. Now here's the thing, with the end date, you can see that one coming a little easier. You know, remember, it's an estimate of time. If that end date is not too far off, I'd go back to that church or exempt entity and say, hey, will you contact the Department of Revenue and get a new certificate, basically. They'll extend it out and have the original start date and then just extend it out. And that usually, you know, if you call them, she'll say, well, how much time you need? And there, print it off, it's available. It's really not that big a deal. And then just they would give you another one. So if you're a contractor, the church or exempt entity, whoever it is, should give you a copy of this. Now, they can just give you this. If it were me, I would want a copy of their exempt entity certificate as well, one of these. But if they don't, you're okay. Also, if it were me, I would have them fill one of these project exemption certificates out for them as being the purchaser and me as the vendor on one. But again, they don't have to, but I would just like that if I were doing books. But if they don't, that's okay. But they should give you a couple copies of this. So what you're going to do is put one and put it in your records, heaven forbid you're audited. Well, now you got this one that's not filled out. I call it a blank one. You're going to make copies of it because that's what you're going to use to go buy your materials without sales tax. Because you'll see on there, it'll say, you know, purchaser or contractor. And so your vendor will be at the top, whoever you're buying your materials from. They put that in their records in case they're audited. Well, let's say you hire a subcontractor. Well, you're going to get this certificate. You're going to give him two of these. One of them made out, you the purchaser, them the vendor, and then one not filled out, and you're going to tell them you need to make copies of that because that's what you're going to use to go buy your materials or if you hire subcontractors. Because it's embarrassing if you got to go back and ask for another blank one. So that's how that works with that project exemption certificate. If there's also another kind of project exemption certificate, I don't have a picture of it. It looks very similar. In fact, it works the same. The only difference is if you get a project exemption certificate, but it is a for-profit business, then you know it's that you'll sometimes they call it an enterprise zone project, or HPIP, which stands for High Performance Incentive Program. Um, that project exemption certificate, the starting process for that is with the Department of Commerce. So usually it's a large business that is expanding. They're going to hire a certain number of employees and pay them a certain dollar amount. Then they would apply to the Department of Revenue, and if they qualify, they get a project exemption certificate. That process takes a lot longer than the other exempt entities. So because of that, they have one thing that the other one doesn't. Now, with either one of them, the contractor cannot get a refund, but the exempt entity can. So, well, the contractor can actually get a refund on the materials for the HPIP Enterprise Zone project exemption certificate, only for those, but for any other project exemption certificate, no. But because of the process and how long it takes, that enterprise zone, there's actually a special publication, the KS 1221, that will allow for that. But anyone else, no. So, but it works the exact same. Start date, end date, keep a copy. Now, there's another kind of project exemption certificate, and it's called an agriculture exemption certificate. It's been around, I think, like 4 years now, something like that. But it's not for every single farming operation. It's very specific. So what I've listed there, I'm not sure if you guys know, we call them NAICS codes. It's a North American Industry Classification System. And that's what I have there. Well, what that means is this is the industry, and these are the only industries right there specific that can get this project exemption certificate. So that, if you see there, it shows 11, 21, 12. That's cattle feedlots. The next one, 11, 21, 20, dairy, cattle, and milk. So you can see they're very specific. Only those industries, 1, 2, 3, 4, 5 industries, only 5 agricultural industries right there can get this project exemption certificate. And it's only good for building, a structure, and the job must be $50,000 or more. So it's very specific. So, you know, if I have a farm say, I want a project exemption certificate, so I want to put in something, well, if he's not one of these things, it isn't going to happen. And if it's not a building, it's not going to happen. And if it's not more than 50,000, it's not going to happen. So it's pretty specific. So, but I'm telling you about it anyway. If you have a, okay, I wanted to show you this as well. Okay, so I told you about project exemption certificates. I want to tell you about this. If you notice, this is an exempt entity certificate, but it looks, I'm going to back up just here just a second. It looks just like this one. This is what I call your regular exempt entity certificate, exempt for direct purchases, right? Well, if you look at this other one I have here, their exemption, if you read on here, it says, well, and it's just, this one specifically is for domestic violence shelters, and it's exempt for indirect purchases. So there's literally language on here. If you read it, it says at the very top, it says contractors may use this certificate in lieu of a project exemption certificate. Although a PEC has recommended the exempt entity, it is recommended the exempt entity obtain one, they don't have to. And then it says down at the bottom, retailer, hey, retailer, materials purchased or furnished by a contractor or the materials and labor of a subcontractor on real property projects may be purchased without sales tax using this certificate. It is not necessary for them to get a project exemption certificate. So that retailer information is for whoever you're buying your stuff from to say, hey, look, this is good. I know this ain't normal. Normally you're used to getting a project exemption certificate, but look, there's language on there. Now there's not very many organizations that have this, but I'm just telling you that because if you come across it, I get a lot of people scratching their head and say, is that made up? No, it's pretty limited though. Of course, you see one is domestic violence shelters, another one's humane shelters, another one is rural volunteer fire departments, another one is Easter Seals, I believe, and Wayside Waves. So there really is not that many, but sure as anything, you'll run across that. So just letting you know that it exists. There's also, I don't know if I have it on here. No, I don't. There's also another one if you work on manufacturing, for like a manufacturing plant. Manufacturers, their exemption is called integrated production machinery and equipment. Their exemption is for the machinery, the manufacturing machinery itself, not the structure. So as a contractor, most of the time, if you're going out there to work on plumbing or lighting or something like that, that's going to be taxable. But if you're working on an assembly line belt, something that is directly related to the manufacturing production, then that would be exempt under the integrated production machinery and equipment. So they have it's an ST-201, and it is called the integrated production machinery and equipment exemption certificate, ST-201. It has a sister certificate called it's an ST-203. It's a warehouse exemption certificate. And usually that is for distribution centers and or grain elevators. So they're a storage area. So very similar. If you notice though, a lot of the like distribution centers, their equipment is very similar to manufacturing. They have assembly lines and all kinds of stuff. So assembly belts, I should say, whatever that is. So that's a specific exemption on that. So if you are a contractor that works on like that equipment itself, it would exempt the parts and labor for that. But if you're working on the building itself, that's going to be taxable, just like any other business. Falls all under all the rules. I'm not sure if any of you work on appliances like freestanding refrigerators and washers and dryers and freestanding stoves, appliance like that. If you are, that's not working on real estate. That's not working on a building or land. It's working on an appliance, and that's working on tangible personal property. So if you are working on one of those things, it doesn't fall under these laws. So there's no designation for residential. There's no designation for original construction or commercial. There's no designation of parts and labor. It's just gross receipts, wherever that happens. So just letting you know, and that's another good reason if you do one of these things to put all applicable sales tax included, because someone getting their refrigerator worked on and you're putting tax on it because you're supposed to, they're going to say, hey, this is residential. You don't need the argument. Oh, I kind of already told you this, but the tools and equipment that you guys purchase to do what it is you do, you're considered the final consumer of those. And so you owe sales tax when you purchase those. Part of the statute also says the rental of tangible personal property is taxable, just like a retail sale. So if you rent a piece of equipment, you're the end user of tools, whether you purchase them or rent them. So you owe tax when you rent those. Now, if you have a project exemption certificate, you are able to rent a piece of equipment to use on that particular project. You can use it only on that project. You cannot purchase it, but you can use it only on that project, and you can rent it without sales tax, rent or lease it. So if I have this project exemption certificate job for a church to replace light fixtures, and that's way up there in their ceiling, so I go rent a lift, and I can rent that lift using a project exemption certificate for that job without sales tax. Can't buy it, can't use it on any other job, but boy, that saves me a lot of money. Now, one thing that does throw people, contractors, not a project exemption certificate. Let's just say we got a regular taxable job, commercial job. If you rent a piece of equipment, let's say you rent an excavator. I said escalator, excavator. Okay, you go rent that. They're going to charge you tax on that. Now it's a taxable job, so you're going to collect tax on any portion that's taxable. Well, that equipment rental is just part of the gross receipts. So you're going to be collecting tax on that, even if you line item it. It's just part of the gross receipts. You are not the one actually renting equipment to them. You had the equipment rented to you. You charge them an equipment rental fee. Well, you're providing a whole service. You're not providing equipment rentals. So that's how that comes to pass. It's part of your gross receipts. So a lot of times people will say, well, I paid tax when I rented it. Why do I got to charge? Well, it's a taxable job. Don't think of it as rental equipment anymore. Think of it as it's just part of your labor, is what it is. So just FYI. If you rent a piece of equipment, and when you rent the equipment, it comes with an operator, do not think of it as renting equipment anymore. Think of it as hiring a subcontractor. So you'll first look and see if, well, the service they provide, is that a taxable service? And if it is the job, is the labor taxable? So that's why I'm saying that. So because a lot of times, like an HVAC company, they'll hire a crane company a lot of times to move the units to like the roof of a commercial building. Well, if I'm a crane operator and I own a crane company and all I do is move something from here to there, I'm not part of the installation crew, and all I do is move it. That's not a taxable service, no matter what kind of job it is. If I'm part of the installation, well, now I'm part of gross receipts. It's sort of like that receptacle for that bakery. So that's why I say that. So what I've said today is I browbeat you about the materials. You pay sales or use tax on the materials. Collect tax on the labor. That job's called a commercial remodel job. And then get some type of exemption certificate for if there's an exemption. Remember, there's not an exemption for residential or original construction. So on page 16 in that book, we have what we call a decision matrix. Basically, if you answer no to all these questions, you're going to be paying tax on your materials and collect tax on the labor. But all this is trying to do is jog your memory to see if any portion of it can be exempt from sales tax. I just threw a whole bunch of information in your head in a short amount of time. What questions do you have? Well, I'm not seeing any questions, but if we do get questions, you might copy our contact information there. There's 3 of us that do this. There's Margot Rangel, Roger Basinger, and me, Carl York.